Ever wondered if your money could work harder in the bustling markets of the developing world? Welcome to the realm of emerging markets, a place where the potential for high returns is as vast as the countries that comprise it. These are markets which are experiencing rapid economic growth and population expansion, creating a fertile ground for investment opportunities. Take for instance the BRICS nations, Brazil, Russia, India, China, and South Africa. These countries are not just known for their sizable populations but also for their vibrant economies that are rapidly evolving. They are like the sleeping giants of the global economy, slowly awakening to their full potential. From sprawling metropolises to massive infrastructure projects, from burgeoning middle classes to increasing digitization, the dynamism of these markets is undeniable. But with these opportunities also come challenges. Intriguing, isn't it? But is it really as lucrative as it sounds, or is there more than meets the eye? Let's delve into the success stories and see if we can uncover the secret sauce. Consider the meteoric rise of Alibaba in China. Born in the early days of the internet, Alibaba swiftly became the dominant force in Chinese e-commerce. It wasn't just about being in the right place at the right time, though that certainly helped. Alibaba's success is also attributed to its innovative business model, which provided a platform for small businesses and entrepreneurs to reach a global market. The Chinese government's rapid adoption and support of internet technologies also played a pivotal role in Alibaba's ascent. Let's travel halfway across the globe to Brazil, where we find another golden story in Petrobras. This oil and gas giant has been a pillar of Brazil's economy for decades. Petrobras leveraged Brazil's vast natural resources and the government's strategic focus on energy independence to carve out a significant market share. Its success story underlines the potential for resource-rich emerging markets to foster homegrown champions. Finally, let's turn our gaze to India, the land of spices and software, where Infosys has made its mark. Infosys, a global leader in technology services and consulting, has thrived on India's rich talent pool and favorable outsourcing trends. The company's commitment to innovation and quality has helped it maintain a competitive edge in a crowded market. The Indian government's supportive policies towards the IT sector also gave Infosys a push towards success. These stories of Alibaba, Petrobras, and Infosys underline a few key factors that have contributed to their success in emerging markets. Market dominance, innovative business models, and favorable government policies have all played a part. But there's no magic formula here. Each of these companies has navigated its unique set of challenges and opportunities to carve out its own path to success. These stories paint a promising picture, don't they? But remember, every coin has two sides. Now, let's uncover the less glamorous side of investing in emerging markets. While the allure of high-growth opportunities can be enticing, it's essential to understand the potential risks. Political instability is one of these risks. A change in government or civil unrest can have a profound impact on an economy. For instance, the Arab Spring in the early 2010s led to significant economic instability across several nations in the Middle East and North Africa. Currency fluctuations is another risk. The value of local currencies against the dollar can swing wildly, affecting the returns of your investments. Remember the Russian ruble in 2014? It collapsed due to a combination of falling oil prices and international sanctions, causing significant losses for investors. There's also the risk of a lack of transparency. Many emerging markets lack the rigorous reporting standards we're accustomed to in developed markets. This lack of information can make it challenging to accurately assess the health of a company or the economy. Regulatory hurdles can also pose a significant challenge. Emerging markets often have complex and evolving regulatory frameworks that can be difficult to navigate. This can lead to unexpected costs and delays. And let's not forget about inflation. High inflation rates can erode the value of your investments over time. Argentina is a prime example of this. In recent years, the country has grappled with inflation rates well into the double digits, making it a risky proposition for investors. So we see that investing in emerging markets is not without its pitfalls. There's the potential for high returns, yes, but also the potential for significant losses. It's a bit like walking a tightrope. One misstep can lead to a nasty fall. But here's the thing. Risk is an inherent part of investing. Whether you're investing in a tech startup in Silicon Valley or a manufacturing firm in Shenzhen, there's always the chance that things won't go as planned. The risks are real, and they can be daunting. But does that mean we should avoid emerging markets altogether? Investing, as in life, is all about balance. It's a delicate dance between risk and reward, a thrilling tango that keeps the financial world spinning. One of the crucial steps in this dance is diversification, a technique that spreads investments across various financial instruments, industries, and other categories to potentially improve overall returns and reduce the risk of losing money. Now, where do emerging markets fit into this equation? Picture them as the spices in a gourmet recipe. You wouldn't want your entire meal to be made up of spices, but a well-judged amount can enhance the flavor and elevate the entire dish. Similarly, investing a portion of your portfolio in emerging markets can add a dash of zest to your financial spread. Emerging markets, by their very nature, are dynamic and can be volatile. But remember, with volatility often comes opportunity. These markets offer the potential for significant growth that may not be available in more mature markets. Think of it as venturing into uncharted territory, where the risks are high, but the potential rewards are even higher. The key to capitalizing on these opportunities is understanding the unique dynamics of each market. Every emerging market has its own set of challenges and opportunities, shaped by factors like economic growth prospects, political stability, and currency risks. It's like stepping into a different ecosystem, where the rules of the game can change quickly. To navigate this terrain effectively, you need a keen sense of observation, a solid understanding of the market fundamentals, and an appetite for risk. It's not for the faint-hearted, but for those who dare. The rewards can be substantial. So, is it worth it to venture into the exciting world of emerging markets? That's a question only you can answer based on your financial goals, risk tolerance, and investment horizon. But remember, a well-diversified portfolio often holds the key to long-term investment success. Emerging markets, with their potential for high returns and inherent risks, certainly make for an exciting investment frontier. It's all about how well you understand the landscape and navigate the terrain.